Weekly jobless claims still near the lowest levels of the year, but rising slightly ahead of tomorrow's payrolls report. The U.S. is expected to add 2,000 jobs, lower than the previous month. Unemployment expected to hold steady at 3.6%. Mike McKee has the preview. Morning, Mike.
Good morning, John. Well, we got some numbers today that do support the idea of a still tight labor market. Jobless claims rise only a slight amount, 227,000 up from 221,000, a gain of 6,000. And the continuing claims number, which everybody's watching because that really tells you where we are in terms of unemployment, just another slight increase. But we did get some very good news ahead of the jobs report, and that is non-farm productivity rises 3.7%. That's the most since 2020 after being down 1.2% in the first quarter. That pushes unit labor costs down to just 1.6%. And here's why that's important is the productivity decline has been making things much worse for companies, and the idea that we get productivity higher means that we can absorb higher wages. So we'll be watching those average hourly earnings. You mentioned the forecast for payrolls and unemployment. Average hourly earnings expected to fall back just a little bit, the increase slow, and if that is the case, then this will be good news for the Fed. The issue for the Fed, of course, is that they don't meet again until September 20th, so this isn't going to be a dispositive kind of jobs report.
They get another one, a CPI report, two of them actually, and another payrolls report in addition to that one. Mike, do you think you can make the case that they're making progress based on the data we've seen so far? Job openings, the quits rate, what you're seeing develop just in terms of the rate of growth in payrolls. Are they making progress?
Well, you could argue they're making very slow progress on the labor side of all this. Inflation has come down quickly. Now it is forecast to slow down. The problem is nobody really knows what's going on. Tom Barkin, the Richmond Fed president, with an interesting speech today saying that we're still feeling the effects of the pandemic in the economy, and we don't know exactly what's going to happen because it's had such weird effects. But, you know, John, the most interesting thing he said was that this recession that people are talking about has been predicted for so long that companies have been able to adapt to that already. They're holding on to workers, they're cutting their expenses, and we see that with productivity and unit labor costs. They're getting ready for it, and so maybe we avoid a recession because everybody's so prepared for one.
How is any of that compatible, Mike, with this idea that we get back to 2%? How is the labour market at the moment consistent with the idea that we get back to 2% CPI inflation in America?
Well, historically, it's not consistent, but this is an anti-historical or an ahistorical kind of recovery. We're seeing things happen that we haven't seen before. The fact that inflation's come down so much without unemployment rising, even if, as Bob Michael says, unemployment's a lagging indicator, that's not what the models would tell you should be happening.
Mike McKee, Mike, thank you, sir. As always, looking ahead to payrolls. The estimate tomorrow, 200K.